Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 4, Corporations, Organization, and Capital Structure. Since we know Chapters 2 and 3 that dealt with the four principal areas fundamental to working with corporations, we got to understand the treatment that applies to entities treated as corporations for federal tax purposes, recognize specific income tax rules that apply to corporations in comparison to individuals. We identified filing and reporting procedures and considered some special situations, some special deductions for corporations. With Chapter 4, we basically continue this approach and we address some of the issues involved in actually forming the corporation, the capital structure, as well as special rules for investors in corporations. And one of the key things that impacts a corporation is this rule called Section 351. So there are some tax consequences when it comes to incorporating a business. So anytime there's property transactions, normally it'll result in a recognized gain or loss when the taxpayers, they sell the property. So let's say I have a building, it is worth $100,000, or I paid rather $100,000 for the building, and the fair market value, the property of the value has appreciated to $150,000. So let's say there's no sale, right? I purchased this building 5 years ago for $100,000. 5 years later, it's now worth $150,000. I'm still utilizing the business. From a tax perspective, it would not make sense to be taxed on the $50,000. I did not sell the property, so it is an unrealized gain. But if I do sell the property, then I would pay taxes on the gain of $50,000. But let's think of it this way. I have this property. It's valued at $150,000. I paid $100,000 for it. I own it. I start a corporation and I transfer this building to the corporation. Should I have to pay taxes on that $50,000? That is the problem that arises. Hence, that is why there's this Section 351. So there's a special provision in the code that applies that when there's a transfer of property to a corporation in exchange for stock, then in such case, there may be a deferment of income. So Section 351, so this is in contrast to the typical result of the full gain or loss recognition. So the Internal Revenue Code permits non-recognition of gain or loss in certain circumstances. One of them is Section 1031. This is for like-kind exchanges. And the other is Section 351. And this is when there's a transfer of property to a controlled corporation. So it doesn't mean that you never pay taxes on these like-kind exchanges or Section 351. The key thing is that you postpone, you delay recognizing the gain until there's a substantive change in the taxpayer's investment, right? So that's generally when a sale actually takes place. So with these Section 351's rules, it's asking us to indicate whether the following statements are true or false regarding Section 351. So A states, Section 351 deals with transfers to controlled corporations. So just keep in mind, unless there's an exception in the code, a transfer of property to a corporation in exchange for stock, it basically constitutes a taxable sale or exchange of property. And the amount of gain or loss is measured by the difference between the value of the stock received and the basis of the property transferred. But when the taxpayer's economic status has not changed, so as mentioned with that example, I have the building for $100,000 in my personal name. I started a corporation and I transferred it. Even though the appreciation is $50,000, I did not sell it. I owned the building before, and I now still own the corporation. So therefore, there's no substantive change. There's no economic change. I don't have the wherewithal to pay taxes on $50,000 because I didn't sell the building, right? So this is one of these exceptions, Section 351. So Section 351 deals with transfers to controlled corporations. This is true. So for the transaction to qualify as non-taxable under Section 351, there's 3 requirements. The first is that the property transferors must be in control of the corporation immediately after the exchange. there is an exchange for stock, and property is transferred. So those are the three requirements. Property is transferred in exchange for stock, and the property transfers are in control of the corporation after the exchange. So B at states, Section 351 provides that gain or loss is not recognized upon the transfer of property to a corporation where certain conditions are met, correct? So I just mentioned there are those three requirements. Property is transferred in exchange for stock, and the property transferors are in control of the corporation after the exchange. Section 351 is elective if a transaction satisfies the provisions requirements. So Section 351 is mandatory if a transaction satisfies the provisions requirements. So this is actually false. The three requirements for non-recognition of gain or loss, as we mentioned, are those three requirements. Therefore, if, for whatever reason, because there are certain situations where taxpayers, they want to recognize the gain. Let's say, as of now, they are in a lower tax bracket, so it would make more sense for them to be able to claim the gain now and pay less taxes. In such case, then the taxpayer must plan to fail to meet at least one of the requirements. So there needs to be some strategic tax planning to ensure that the three requirements are not met. D states non-recognition of gain occurs only when the shareholder receives stock. So stock includes common and most preferred. However, it doesn't include any non-qualified preferred stock, which is essentially similar to debt. So in addition, the regulations state that the term stock, it does not include stock rights, and it does not include stock warrants. So D is true. Now we look at question 2. It says, because this transaction is blank, the control of the corporation requirement, Janice has income of blank and Tom has income of blank. So here it states Janice and Tom form Level Corporation. Janice transfers equipment worth $60,000, basis of $40,000 for 50% of the stock in Level. Tom transfers inventory worth $20,000 with an adjusted basis of $15,000 and provides services worth $40,000 for 50% of the stock. So one key thing to keep in mind is that, again, we know the three requirements. Property is transferred in exchange for stock. The property transfers are in control of the corporation. So as it relates to property, generally, property is defined as basically any asset. It can be cash, equipment, intangible assets, installment notes, etc. But one key thing that is specifically excludable by Code Section 351 as property are services. Services are not considered property. So whenever a shareholder provides services, they need to recognize it as income on their tax return. So the taxpayer has to recognize income that's equal to the fair value of the stock that they received. So just keep that in mind. So services do not count towards the 80%. However, there is a special exception. So in the event that a person contributes both services and property in exchange for corporate stock, so again, they're going to need to include in taxable income the value of the stock received for services, but not the value of the stock received from the property, assuming that the property transfers control the corporation. So how do we determine? So we have this thing called nominal property. So to be part of the group, they have to meet the 80% control test. So when we say property transfers are in control, control is deemed as 80% or more. So the person that contributes services must transfer property that has more than a relatively small value compared with the services performed. So what this simply means, and just keep in mind, the IRS, they don't necessarily have like a definition, but the IRS stated that the control group, as mentioned, includes the person who contributes both property and services if the value of the property equals or exceeds 10% of the value of the services provided. So here we look at this example and we look at what Tom transferred. Tom transferred inventory and services worth $40,000. So how would we determine? So the key thing we need to look at is, all right, Tom transferred inventory, and the worth of the value of the inventory is $20,000, and he also provided services of $40,000. So in such case, we look at the math. So 20,000, which represents the value of the stock received, divided by the value of the services performed. So in such case, because of the value of the property Tom transfers is not small relative to the value of the services. So he transferred inventory that was worth $20,000, and he provided services worth $40,000. So, which is 50%. So therefore, Tom would be able to qualify for the Section 351 requirement of control. Janice, she transferred property. So therefore, both Janice and Tom's contributions equate to 100%. So Section 351 requirements would be met. So because this transaction meets the control requirement, Janice has income of $0. She doesn't need to report any of it because she gets to defer the $20,000 gain. The basis of the equipment is $40,000. The value is $60,000, so she has a deferred gain of $20,000. And in such case, Tom transfers the inventory worth $20,000, the adjusted basis of $15,000. So Tom gets to defer $5,000 of gain. However, he has to recognize the $40,000 for services provided as ordinary income. So again, the key thing to determine the relative, and again, it cannot be a relatively small value. You divide the value of the property contributed by the value of the services provided. And in this case, it was 50%. This question states, indicate whether the following statements are true or false regarding tax planning opportunities associated with organizing and financing a corporation. If the tax-free treatment of Section 351 is desired, ensure that the parties transferring property, which includes cash, receive control of the corporation. Correct. It can't be 79.9. It cannot be 77. It has to be 80% or more. B, a transferor might prefer to avoid Section 351 to allow for immediate recognition of loss. This is true. So in the event that a transferor wants to recognize loss, they have several alternatives. They can basically choose to sell the property to the corporation for a stock. They could sell the property to the corporation for other property, or also receive boot. So boot is basically anything in addition to receiving stock. And so because the transfer receives no stock, Section 351 would not be allowed. And then lastly, the individual can decide to transfer the property to the corporation in return for securities or non-qualified preferred stock. So C states, a transfer of assets that produce passive income, such as rents, royalties, dividends, and interest, can cause a corporation to be a personal service corporation. So this is actually false. When a business is incorporated, the organizers, they essentially need to determine which assets they're going to transfer, which liabilities they're going to transfer. So a transfer of assets that helps to produce passive income. So passive income is basically, money, making money by itself, right? Making money with minimal effort. So that's like if you have a rental property, again, the building provides the service. You don't need to go every day. Obviously, there might be some upkeep and things of that nature, but the building in and of itself is what generates the revenue versus you going to work every day, right? So that's earned income versus passive income. So a transfer of assets that produces passive income can cause the corporation to be a personal holding company in a tax year when operating income is low. Thus, the corporation could be subjected to personal holding company penalty tax in addition to regular income tax. So just keep in mind, a personal service corporation is a corporation that is created for the sole purpose of providing personal services to individuals or a group of people. D, only the original shareholder of Section 1244 stock is entitled to ordinary loss treatment. So with Section 1244 stock, this is essentially for, small business stock. And what essentially happens is that when you own Section 1244 stock, in such case, you are allowed to claim ordinary losses, which obviously is more favorable when compared to capital losses, because capital losses, those are capped at $3,000 per year. So let's say a client has a capital loss of $9,000. It would take them 3 years to write it off because there's a maximum loss of $3,000 per year versus an ordinary loss. So if Section 1244 is claimed, the individual can claim the entire $9,000 loss in the year of worthlessness. So this is true. So this is asking us, determine the effects of Section 351 for the following taxpayers. A states Grady exchanges qualified property basis of $12,000 and fair market value of $14,000 for 60% of the stock of Edie Corporation. The other 40% of the stock is owned by Pedro, who acquired it 5 years ago. So we know 3 requirements. 1, property is transferred. 2, there's an exchange of stock. And 3, the transferors are in control. In control is defined as 80%. So Grady made an exchange, but only for 60% of the stock. He didn't receive anything other than stock, but one thing we know is that he does not qualify because only 60% of the stock was received. So therefore, because this transaction does not meet the control of the corporation requirement, Grady has income of, so we consider the basis, which is $12,000, and the fair market value. There's a difference of $6,000. So therefore, Grady has to recognize the gain on $6,000, and his basis in the stock is the fair market value, which is $18,000. For B, it says Trey, Amy, and Aaron incorporate their businesses by forming Whitehead Corporation. As a part of the prearranged plan, Trey exchanges his qualified property with a basis of $500, fair market value of $1,000 for 100 shares in Whitehead on May 9th, 2024. Amy exchanges her qualified property, basis of $1,800, fair market value of $2,000 for 200 shares of Whitehead Corporation stock on May 12, 2024. And Erin exchanges her qualified property for 300 shares in Green on March 5th, 2024. So we need to determine, does this transaction, meet the requirements? So the transactions meet Section 351 control requirements because the 3 exchanges are a part of a prearranged plan. So you might look at it and say, hey, wait, this person made the contribution on May 9th. This person made it on May 12th. The other made it on May 5th. This is a prearranged plan. So the non-recognition provisions of Section 351, it applies to all exchanges. So therefore, none of the taxpayers have any recognized gain on the transfers, and each one has a substitute basis in the stock equal to the basis in the property contributed. So keep in mind, whenever Section 351 is not met, the fair market value represents the basis in the stock. And whenever Section 351 is met, the basis of the stock represents the basis of the property that is transferred. So because this transaction meets the Section 351 control, Trey has 0 of income. He doesn't need to recognize income. And his basis in the stock is $500 for his qualified property. Amy has income of 0. And the basis in the shares is $1,800. Aaron exchanges, property with a basis of $2,000. So the income is 0. And $2,000. So again, that's something important to keep in mind. When Section 351 is met, the basis in stock is the fair market value. And when Section 351 is met, then the basis in stock represents the basis in the property that was transferred. And then here we see in this example, just quickly, none of them contributed both services and property, so we do not need to account for the nominal property. In such case, they only contributed property in exchange for stock, and they meet the 80% requirement. This question states, under what circumstances will a recognized gain and or loss be recognized on a Section 351 transfer? Indicate whether the following statements are true or false. So it states the nature of property determine the types of gain. This is true. The gain can be ordinary or the gain can be capital based on the type of asset that was transferred. B, shareholders realize loss in a Section 351 transfer if they receive cash as boot in the exchange. This is false because shareholders never recognize or realize loss in a Section 351 transaction. C states a recognized gain equals the lesser of the gain realized or the boot received. So this is true. So in a situation where, let's say, an individual receives stock and cash, they essentially would claim a gain to the extent of the cash received or to the extent of the boot received. So they would claim the lesser of the realized gain or the basis in the fair market value of the property received. So C would be true. D, normally any realized gain or loss is postponed until a substantive change in the taxpayer's investment occur. For example, a sale to outsiders. This is true. So as mentioned, Section 351 is mandatory. So in the event that, there's a sale that takes place, however, that is when they essentially need to account for the realized gain because now there was something substantive that took place. They actually sold the property. So D is correct. But one key thing to keep in mind, shareholders never recognize a realized loss in a Section 351 transfer, but they do recognize gain. E, a realized gain is never recognized in a Section 351 transaction. This is false. Why? Because again, sometimes there might be boot. So in the event that the taxpayer receives something in addition to the stock, then the taxpayer is going to have to recognize some or all of the realized gain when they receive the boot. It can be cash or any property other than stock. And in such case, the recognized gain equals the lesser of the gain realized or the boot received, which is basically the amount of cash as well as the fair market value of any other property received. So just keep that in mind. Next, we have this question where it's asking us to determine the income and the basis. It says, determine Marie and Ramesh's current income, gain, or loss, and calculate the basis that each takes in the Roundtree stock. Marie and Ramesh form Roundtree Corporation with the transfer of the following. Marie performs personal services for the corporation with a fair market value of $80,000 in exchange for 400 shares of stock. Ramesh contributes an installment note receivable, basis of $25,000, fair market value of $30,000, land, basis of $50,000, fair market value of $170,000, and inventory, basis of $100,000, fair market value of $120,000 in exchange for 1,600 shares. So based on this, we see Marie, she just performs services. It does not mention anything about her also contributing or transferring property. So Marie has income of $80,000 and she has an $80,000 basis and her 400 shares of stock. Ramesh, in such case, we have to factor in, all right, he exchanged 1,600 shares. So we need to determine, all right, how many shares? And does he meet the requirement? Because sometimes the control group could just be one person. It doesn't always have to be two people. So let's see. So there's 400 shares of stock that Marie owns and 1,600 shares for Ramesh. So 400 plus 1,600 gives us 2,000 shares. So Ramesh owns 1,600 of the 2,000 shares. Therefore, the Section 351 requirements are met for Ramesh buying himself. So he recognizes $0 of income, and his basis in the stock is equivalent to the basis of all of the items that he contributed. And how do we determine the basis? And again, because Section 351 requirements are met, the basis in the stock is equivalent to the basis in the transferred property. When Section 351 is not met, the basis in the stock is equivalent to the fair market value. So here we go. The installment note, there's a basis of 25,000. The land, there's a basis of 50,000. In the inventory, there's a basis of 100,000. So his basis in the 1,600 shares of stock is $175,000. For this example, it states, calculate Grady's income, gain, or loss, and the basis he takes in his shares of ED stock as a result of this transaction. Grady exchanges property with a basis of $12,000 and a fair market value of $18,000 for the 60% stock of ED Corporation. So in this case, because this transaction, it does not meet it, he transferred the property and only received 60%. So therefore, it does not meet. Grady, in this case, has a gain of $6,000 and $18,000 basis. So because Section 351 was not met, the basis in stock represents the fair market value. How did we calculate the 6,000 to be recognized as gain? It is the difference between the basis of 12,000 and the fair market value of 18,000. Since there was an appreciation of value, it would be recognized as a gain. Here it asks us to determine Jocelyn's recognized gain or loss and the basis in the Zion stock received. Jocelyn contributes land with a basis of 60,000 and a fair market value of 90,000, and inventory with a basis of 5,000 and a fair market value of 8,000 in exchange for 100% of Zion Corporation's stock. The land is subject to a $15,000 mortgage. So generally, when liabilities are assumed by another party, the party that's relieved of the debt, in this case, Jocelyn, she's treated as having received cash or boot, right? Because they are assuming the $15,000 mortgage. So that's considered boot. There is what's called Section 357A, however, and that provides that when an acquiring corporation assumes a liability in a Section 351 transaction, the liability is not treated as boot received for gain recognition purposes. However, the liability that's assumed by the corporation, in this case, Zion Corporation stock, it's treated as boot in determining the basis of the stock received. So as a result, the basis of the stock received is reduced by the amount of the liabilities assumed by the corporation. So again, when the acquiring corporations assume the liability is not treated as boot for gain recognition purposes. So Jocelyn doesn't need to recognize gain just because they assume the liability. However, the liability that's assumed, it does have an effect on the basis of the stock. It reduces it. But just keep in mind that the Section 357A, it has two exceptions. That's Section 357B, the first. So that's basically if the principal purpose, the main reason, why the business assumes the debt is to avoid tax, or there's no real reason why, the corporation assumed the liability, then Section 357A might not apply. And then two, Section 357C provides that the sum of the liabilities exceeds the adjusted basis of the property transferred. Then in such case, let's say they, took on the mortgage and it was 100,000 and the adjusted basis of the property transferred were 75,000. In such case, $25,000, the excess is going to be considered taxable. So just keep that in mind. So in this case, Jocelyn receives 100% of the Zion stock, as we see here. and she is relieved of a $15,000 liability in exchange for property with an adjusted basis of $60,000. How do we determine that? 60,000 fair market value and inventory with a basis of $5,000. Sorry, 60,000 basis and $5,000 basis for the inventory, right? So in such case, we add these up, $60,000, the basis for the land, plus $5,000, the basis for the inventory. So we know that. And then the fair market value for the land is 90,000, and the fair market value for the inventory is 8,000. So 98 compared to 65. So the exchange is tax-free under Section 351 because, again, under Section 357A. However, the basis of Jocelyn's stock is reduced. And because Section 351 was met, again, we use the basis of the property transferred to determine the stock. So it will be as follows. The $60,000 for the land, the $5,000 for the inventory. But again, because of the liability that was assumed, it reduces the basis to $50,000. So the exchange is tax-free under Section 351 because the release of a liability is not treated as boot under Section 357A. And as a result, Jocelyn has income of $0 and a basis of $50,000 in her stock, which is the basis of the land plus the basis of the inventory minus the $15,000 liability assumed by the corporation. This problem asks us to determine the recognized gain on the transfer and the basis for stock. So here we see Diego transfers real estate with an adjusted basis of $260,000 and a fair market value of $350,000 to a newly formed corporation in exchange for 100% of the stock. The corporation assumes the liability of the transferred real estate in the amount of $300,000. Determine Diego's recognized gain on the transfer and the basis of stock. So this ties into what we just discussed with Section 357A. We need to factor in, okay, what's happening in the situation. The basis for his property is $260,000, and the liability assumed is $300,000. So therefore, we need to factor in that he needs to recognize a $40,000 gain. The liability that they assumed is way more than the basis. So therefore, he has to recognize a $40,000 gain. And in such case, we need to determine what his basis is. So his basis is $260,000. And we know that the basis in stock is reduced by the liability assumed, but this will give us a negative $40,000. Corporation cannot have a negative basis in stock. It cannot, be less than zero. So therefore, his basis in stock would be zero because the liability assumed reduced by his basis is a negative amount. But again, the basis for stock can never go below zero. And then just another quick thing. Another way to calculate this, or the basis rather, we start off with the basis of the property transferred. We would add the gain of $400,000. We would subtract, would add the basis of $260,000, add the gain, which gives us a total of $300,000. We would subtract boot, in this case it was zero, and then we would subtract the liabilities assumed, which gives us a basis of zero. So again, to determine the stock basis, it's the basis of the property transferred plus gain recognized, if any, minus boot received, if any, minus the liability assumed, if any. This brings us to our next question. It states, calculate Ion Corporation's basis in the equipment and determine Yvonne and Simon's basis in the Ion stock. It says, Yvonne and Simon form Ion Corporation. Yvonne transfers equipment with a basis of $110,000 and a fair market value of $165,000 to Ion Corporation. Simon invests cash of $130,000. They each receive 100 shares in Ion Corporation worth $130,000, but Yvonne also receives $35,000 in cash. So she receives boot. Now, in this example, the previous examples, it was, asking us about the shareholders. Now it is asking us about the corporation and their basis. So it's important for us to determine how do we calculate first and foremost the corporation's basis, and how do we calculate the shareholders' basis. So one key thing to keep in mind, and you can also find this in the textbook, the shareholders' basis of stock received. So this is, as we just mentioned with that previous example, the adjusted basis of property transferred plus gain recognized, if any, minus boot received, if any, minus the adjustment for lost property, and this gives you the basis of stock received, versus the corporation's basis in property, which is the adjusted basis of property transferred, plus gain recognized by the transferor shareholder, minus any adjustment for lost property, and that equals the basis of property rather, to the corporation. All right, so back to the fact pattern here. The first thing we need to do is determine Yvonne's stock basis, and it will be as follows. So there's a $130,000 worth of stock received. It says they each receive 100 shares in Ion Corporation worth $130,000. In Yvonne's case, we need to factor in the boot received. She also received $35,000. And then from there, we need to factor in the basis of the equipment. Yvonne transferred equipment with a basis of $110,000. So we subtract the $110,000. So there's a $55,000 realized gain. So keep in mind, there's a difference between a realized gain or a recognized gain. So in this case, this is the realized gain. But in order for us to determine the recognized gain, it is the lesser of the two. So it's the $55,000 of the realized gain versus the boot received, which is $35,000. So in such case, we would claim the lesser of the two. So of the $55,000 gain, only $35,000 is considered recognized. Let's see. All right. So based on this information, Yvonne's, basis in the stock, or we'll start with Ion Corporation rather. Ion's Corporation would be Yvonne's basis of $110,000. So they, meet the Section 351 requirements, but the only thing is that in this case, Yvonne has to recognize the $35,000 worth of gain. So Ion Corporation's basis would be $145,000. How do we determine that? Again, we look to the information, which lets us know adjusted basis of the property transferred, which is $110,000, plus the gain recognized by the transferor shareholder, which is the $35,000. Even though there was a realized gain of $55,000, it is limited to the lesser of the boot received or the recognized gain. So Ion Corporation's basis is $145,000. Yvonne has a basis of, and we will calculate it as follows. We start off with her basis in the equipment, $110,000. From there, we subtract the boot received. And then we add the lesser of the realized or recognized gain, which in this case was the $35,000. So there's a basis of $110,000. So again, we add the basis of property transferred, $110,000, plus the gain recognized of 35,000 minus the boot received of 35,000, which gives us a basis of stock received. So the gain received basically, or the boot received rather, basically washes itself out. We start off with the adjusted basis of 110. We add the 35,000 recognized, and then we minus the $35,000 boot, and that gives us the 110. So Yvonne has a basis of 110,000, and Simon has a basis of 130,000, which is equivalent to the basis of how much he has contributed, in this case of cash. This example, it says, determine the amount and nature of Min Jung's gain or loss recognized this year in each of the following scenarios. So this is dealing with section 1244 stock. So with section 1244 stock, anytime there's a gain on a sale, the gain remains capital. So just keep that in mind. So, it's favorable. It's treated at 0, 10, or 15%. 0, 15, or 20% rather. So with the section 1244 stock, when there's a loss, it makes it more beneficial for those who qualify. So the ordinary loss treatment for section 1244 stock, it is favorable in comparison to capital loss because, as mentioned previously, capital losses are capped at a maximum of $3,000 per year. So in the event that a taxpayer has a $9,000 capital loss, it will take them 3 years to write it off versus an ordinary loss that would be able to claim in full in the year of loss. But with section 1244 provision, the ordinary loss treatment for stock applies to the first 1 million of capitalized value of a corporation's stock. And in the event that, let's say, a corporation issues more than 1 million, then the entity basically, they differentiate between which shares actually qualify for this treatment. So the amount of ordinary loss deductible in any year for the disposition of this 1244 stock is limited to $50,000 for all taxpayers other than those that are married filing jointly. In a married filing joint return, the deduction doubles to $100,000, or the limitation rather. So in this example, it says in 2016, Min Jun, who is single, acquired original issue stock in Blue Corporation at a cost of $60,000. This stock meets the definition of both 1202 and 1244 stock. This year, Min Jun sold the blue stock. Determine the amount and nature of Min Jun's gain or loss recognized this year in each of the following scenarios. So it's asking us, how would we record it if the stock is sold for $5,000? So she purchased it for $60,000 and sold it for $5,000. In such case, $5,000 is how much we sold it for, minus the $60,000. Therefore, there would be a $55,000 loss. So it will produce a total loss of $55,000, in which case the first 50 receive ordinary loss and 5,000 is treated as an ordinary loss. So in this case, let's say the stock is sold for $500,000. And because this stock is 1202 stock for Min Jung, and it was acquired at an original issue after September 27th, then they basically have the privilege to exclude rather 100% of the realized gain. In this case, the realized gain would be as follows. Sold for $500,000. The basis, the amount paid was $60,000. So there's a $440,000 realized gain. But in such case, because it is section 1202 stock, none of it needs to be recognized as a gain. Same fact pattern, section 351. It asks, Maria and Bob form Robin Corporation. Maria transfers property worth $420,000 with a basis of $150,000 for 70 shares in Robin Corporation. Bob receives 30 shares for property worth $165,000 with a basis of $30,000 and legal services worth $15,000 in organizing the corporation. So Section 351, as we know, it is mandatory if the provision requirements are met. First, property is transferred. 2, in exchange for stock. 3, the property transferors are in control of the corporation, and this means that they own 80%. So, in this case, Section 351, do we know if it's met or not? How would we determine it? So for part A, it's asking us, what is the gain or income, if any? So they essentially meet the provisions, because again, we have to factor in a nominal value. So Bob received 30 shares for the property and the legal services. So we know it needs to be at least 50%. So here we see that, $30,000 the share was worth, and then $15,000 for the legal services. So in such case, 15,000 represents the legal services. 10% means he would need to contribute property that's worth at least 1,500. This far exceeds it. So therefore, Bob's contribution is determined for the control of the corporation. So therefore, Maria would recognize no gain or loss. Section 351 is met. $0 in income. Bob, although Section 351 is met, again, anytime services are provided, it is treated as ordinary income of $15,000. Now for part B, it's asking, what basis does Maria and Bob have in the corporation stock? So because Section 351 is met, the adjusted basis, which is the equivalent to the cost of the item, that represents their basis. So Maria has a basis of $150,000. And now for Bob's basis, we need to do some calculations. So his basis would be the $30,000, which represents his basis in the property transferred, plus the income recognized, which was the $15,000, minus any boot, which he did not receive. So $45,000 minus 0. Bob's basis in the stock is $45,000. Now, part C asks, what is Robin Corporation's basis in the property and services received from Maria and Bob? So the basis of property received by the corporation is generally determined under a carryover basis rule. So this rule basically means that the property's basis to the corporation is equal to the basis in the hands of the transferor, increased by the amount of any gain that's recognized on the transfer. So in such case, Robin Corporation, they have a basis of $150,000. In the property that Maria transferred. And then in such case, for Bob, they have a basis of $30,000 in the property. Why so? And you might say, okay, well, if Bob's basis is $45,000, why is their basis $30,000? The reason being is because $30,000 represents his basis, and the $15,000 paid for legal services, that will be treated as an organizational expenditure. So it would be recorded as an expense. So that's a key thing to keep in mind. The basis for the corporation, Bob transferred services in addition to the property. So the basis of the property remains the same, but in Bob's case, he had to increase his basis for the $15,000 gain. But as it relates to the corporation, their basis in the property Bob transferred will be $30,000, and the $15,000 will be capitalized. This question states, with respect to the calculation of the basis of stock received by a shareholder in a Section 351 transfer, label each of the following as being either true or false. Shareholders that transfer a liability to the corporation along with property must reduce the basis in the stock received by the amount of the liability they transfer to the corporation. This is true. So shareholders that transfer a liability to the corporation along with property, yes, they need to reduce the basis in the stock. So just keep in mind that the transfer of the liability to the corporation, it will not produce gain to the transferor shareholder unless, of course, the liability that's assumed. So let's say the liability assumed is $20,000 and the basis is $15,000. In such case, there would be a gain of $5,000. Right? So that would be an example where the transfer of the liability would produce a gain. The second example would be if, it's a tax avoidance scheme or there's no bona fide business purpose for the corporation assuming the liability. B, the shareholder's basis in the property transferred becomes the basis of the stock received, increased by the amount of gain recognized by the shareholder and decreased by the fair market value of boot received and the amount of liabilities transferred to the corporation. This is true. The shareholder's basis in the property received becomes the basis of the stock received, and then from there it's increased by the amount of gain recognized by the shareholder and further decreased by the fair market value of the boot received and the amount of liabilities that were transferred to the corporation. C states, if a shareholder transfers property with an aggregate adjusted basis in excess of its fair market value, there's Section 362E2, which generally requires the corporation to step down the carryover basis for the property by the amount of the net built-in loss. This is true. And lastly, D, it states a shareholder that receives other property boot in addition to stock in a Section 351 transfer loss is recognized by the shareholder to the extent of the lesser of the loss realized or the fair market value of the boot received. So false. Anytime a shareholder receives other property, which is considered boot, in addition to stock in a Section 351 transfer, they recognize gain equal to the lesser of the gain realized or the fair market value of the boot received. And under Section 358A, this provides that the shareholder stock basis, it equals the basis the shareholder had in the property transferred, increased by any gain recognized on the exchange and decreased by the boot received. So this is actually false. Complete the statements below in response to the question. How does the transfer of mortgaged property to a controlled corporation affect the transfer of shareholders' basis in stock received? So, as mentioned, the shareholders' basis in stock, it is increased, reduced, or not affected. So generally when liabilities are assumed by another party, the party that, who the debt was assumed for, they treat it as having received cash or boot. But Section 357A provides that if, the corporation is not, trying to avoid taxes, or the shareholder is not trying to avoid taxes, and there's a bona fide purpose for assuming the debt, in addition to the fact that, the liabilities do not exceed the basis of the property transferred, no gain is recognized for the liability assumed. However, the liability assumed does have an impact on the shareholder's basis in stock. So the shareholder's basis in the stock received is reduced by the amount of liabilities assumed by the corporation. Here, this question, it says, as a result of these transfers, Hunter and Warren from Tan Corporation, Hunter transfers equipment with a basis of $210,000 and worth $180,000, while Warren transfers land with a basis of $15,000 and worth $150,000 plus $30,000 cash. Each receives 50% of Tan's stock as a result of these transfers. So this fact pattern, clearly Section 351 applies, right? It doesn't say anything about them contributing both property and services, so we don't need to factor in nominal property. But we see they both receive 50%. They both transfer property. 50 plus 50 is 100. Therefore, they have ownership. So based on this, Hunter does not have to here we see the basis of 210 worth 180. Basis of 15 worth 150 plus 30 in cash. So in such case, Hunter has a recognized loss of 30,000 and Warren has a recognized gain of 135,000. And although cash is involved, it was given, not received by Warren. So that's the key thing, for this fact pattern. The corporation did not give Warren cash. Instead, Warren is the one that gave cash. So based on this, neither Hunter nor Warren has any recognized gain or loss. This brings us to our last question. For this transaction, Mary transfers a building with an adjusted basis of 15,000 and worth 90,000 to White Corporation. In return, Mary receives 80% of White Corporation's stock worth $65,000 and an automobile worth $5,000. In addition, there is an outstanding mortgage of $20,000 taken out 15 years ago on the building that White Corporation assumes for this transaction. So as a result of this transfer, Mary receives boot of $5,000. How do we know? It says she received an automobile worth $5,000 and has an additional gain of $5,000. How do we know? There's an excess of the mortgage. So it lets us know that there's an outstanding mortgage of $20,000, but her basis in the building is $15,000. So therefore, she needs to account for the $5,000, the fair market value of the automobile, which is boot, and the additional gain due to the excess of mortgage over the basis of the building. So we need to factor in these amounts. We see that the building is worth 90,000. There's an adjusted basis of 15, so 90,000 minus the 15,000. There's a realized gain of 75,000. So we essentially claim the lesser of the two. The boot received plus the excess of the mortgage over the basis. So therefore, Mary needs to recognize a gain of $10,000. All right, so this brings us to the end of questions for chapter 4, which governs corporations, organizations, and capital structure. And one of the key things in this chapter is section 351, which essentially defers or postpones the recognition of gain when 3 requirements are met. The first is that property is transferred by the shareholder to the corporation. 2, stock is received in exchange. And 3, the transferors, whether it is one person or multiple people, they are in control of the corporation, and that control percentage is 80%. In the event that shareholders want to avoid section 351 because it is mandatory if the requirements are met, they basically just need to plan to make sure that they do not meet the requirements. All right. We also discussed section 357, which deals with liabilities that are assumed by the corporation. So when liabilities are assumed for a taxpayer, generally it's treated as boot. But for purposes of section 357, so long as the assumption of liability has a bona fide purpose, it is not to avoid taxes, and the mortgage, the liability assumed rather, does not exceed the basis, then there's no need to recognize a gain. However, liabilities assumed by a corporation, they do reduce the basis in stock. All right, so again, this brings us to the end of chapter 4.